Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's our webinar's topic is the difference between investing in REITs and physical properties in Malaysia. So welcome to this session. So I'm sure many of you here are already investor one way or another. Some of you here could invest in property. Some of you here are investing in the capital market. So today we are going to dissect what are the differences between investing in physical properties as opposed to investing in real estate investment trusts. All right. So disclaimer, whatever you share in this webinar is only for educational purpose. So in no way that I give you any recommendation for you to buy and sell any listed companies that we mentioned here. So should you invest, so you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker today. We are very honored to have Ian Tai here to be with us today to talk about REITs versus properties. So Ian Tai is the content producer of kclau.com. He has written more than 200 articles on kclau.com. He is also a weekly webinar host and presenter on kclau.com. He is also a co-founder of Dividend Vault, which they manufactured savvy investors who can build dividend-based portfolios independently. So he himself is a dividend investor. He primarily invests for dividend income, and his yields is ranging between 2 to 8% per annum. And what is notable about Ian is that he's also an author of 3 investment books. Yeah. So yes, he has written and published 3 investment books. So today we are very happy to have him here to talk about real estate investment trust versus physical properties. So Ian, welcome to Bursa webinar.
Hello Shane. Hello everyone. So yes, once again, it's an honor and privilege to be here today. And yes, first and foremost, would like to thank Shane for your kind introduction. And also, thank you so much for your team who actually does a lot of work behind the scenes organizing this webinar session. And guys, I've actually prepared a lot of materials, so let's get right into it. So let me just share with you my screen. Okay. Okay, so this is actually the question for today's webinar session, which is investing into REITs better than investing into physical property? Now, guys, I mean to say, maybe you guys have come in with an opinion and a viewpoint on which of the two is actually better. So perhaps you can actually type in the chat box. Let us know. Let me know. Let Shane know which of the two do you actually prefer to invest. Is it REITs or is it physical properties? All right, you can actually type that in the chat box. And of course, along the way during this webinar session, if you have any questions along the way, just feel free to put your questions in the Q&A box. And I'm very sure that Shane will be moderating this the Q&A session after this webinar session. So let's check out the response. And a lot of you actually says REIT. So thank you so much for your response. And for myself, actually, I don't make a preference. If I'm one of you guys today listening to this webinar, I'll probably say both actually, simply because I actually have both. I mean to say, I also do have a small property portfolio and as well as a small REIT portfolio. So I think that having both is actually pretty good. But anyway, here the question is this. So what are the differences? Okay, so although let's say for example today, I'm in a position whereby I have both, but at the same time, I also like to know what are the differences between the two if I want to actually move on in my investment journey. So let's take a look at what are the differences, what are the considerations that we need to consider so that we can actually decide for ourselves which of the two is actually will be more suitable as an investment, all right? Is it REITs or is it physical properties? So for this webinar session, we'll be discussing 5 key factors, okay? 5 key factors so that we can actually make better investment decisions on this. Is it REITs or is it physical properties? So let's go through these 5 factors one at a single time. So the thing to consider, number 1 is actually, factor number 1 is the minimum capital required, okay? So this is something that we need to consider. So why do we need to consider this? Well, for very obvious reasons. So if you look at physical property, well, the first thing we need to do is that we need to know is this. So as a Malaysian, as a local buyer, so we know that when it comes to buying a physical property, let's say we are talking about a residential property. So the first and second residential property that we buy here in Malaysia, we need to actually put down 10% down payment on the property price, all right? So this is actually the first thing that we need to prepare. And of course, apart from the 10% down payment, there are a bunch of transaction costs. In total, there are 5 transaction costs that we need to prepare in order to purchase a single property, okay? So this will include the legal fees to prepare the sales and purchasing agreement, the legal fees to actually prepare the loan agreement, and then we need to pay for the stamp duties for both the SPA, which is the sales and purchasing agreement, and as well as the loan facility agreement. So that is 1, 2, 3, 4. And last but not least, we also have to pay for the property valuation report. So why do we need to pay for this? Simply because if you are actually getting a loan from the bank wants to know what exactly is the value of the property that you are purchasing. And based on that, they will actually take that into consideration in order to process your loan application. Okay, so that is actually very important. So these are the 5 things that we need to prepare. These are all transaction costs we need to prepare when it comes to investing in a physical property. And of course, apart from the down payment and the transaction costs, there are also other associated costs that is involved when it comes to purchasing an investment property. The first one is that we need to actually consider the renovation costs. The second one is that if you're buying a bare unit, maybe you need to do some furnishing. You need to buy some furniture in order to furnish the house. This could be part of the consideration. And last but not least, this is actually something that is very important, which is that it is also very important to prepare ourselves a reserve fund. Okay, a reserve fund, because when we buy property, most people actually don't buy the property cash. All right, very few people in Malaysia has that kind of especially at a young age, has that kind of financial capability to buy a single property, a residential property with cash. So chances are we're going to get loan. So therefore, I think it is actually very wise for us, very prudent for us to actually prepare a reserve fund that allows us to service at least 12 months worth of our mortgage payments. Okay, so now let me put all these costs into perspective. Okay, so let's say, for example, in the Klang Valley, let's say we want to buy a single piece of residential property for investment. And let's say the price is about 300,000 ringgit. So we have the down payment, which is about 30,000. And on top of that, we got the transaction costs. So let's give it a rough guess. Let's say the transaction cost will cost us about 10 to 15,000. Okay, so that's already 40 to 45,000. And then we have to do a little bit of renovation, furniture, and some reserve fund. That could easily take us another $20,000 to $30,000. So therefore, the initial capital outlay that we all need to prepare will be about 75,000 to 80,000 ringgit. Yep. Okay. So if you want to buy a piece of property which is priced around $300,000, it is better for us to prepare in advance 75,000 to 80,000 ringgit in our bank account, so that we can actually qualify ourselves, so that we can actually be financially prepared to buy that single piece of property. But today, if we are considering an investment into a REIT, this will be a very different story. Okay, so here I have actually listed down 4 REITs which are Sharia compliant. Okay, because in Malaysia we have about 18 REITs listed on Bursa Malaysia. 14 of them are not exactly Sharia compliant. Only 4 qualifies to be Sharia compliant. So these are the 4 REITs. So I'm going to just name them, and I'm going to just state the minimum amount of investment needed in order to purchase these REITs. So the first one is actually Al-Aqar Healthcare REIT. So this is actually a REIT that invests in a bunch of KPJ hospitals. So today, as I check Google Finance, or you can actually check it from Bursa Malaysia, the unit price of Al-Aqar Healthcare REIT is 1 ringgit and 20 cents. So the minimum the minimum amount of units to transact, either to buy or sell, is 100 unit. Okay, so that means say the minimum amount of investment that you need to put in order to buy Al-Arca Healthcare REIT is 100 unit times RM1.20, and therefore your minimum amount of capital to start investing in the REIT is 120 ringgit, excluding transaction costs like brokerage fees and some stamp duty. Now, let's move on to Al Salam REIT. So Al Salam REIT, the unit price for today is 48 cents. So therefore, if you take 100 units and times 48 cents, therefore the minimum amount of money that you need to invest will be 48 ringgit. For Axis REIT, because the unit price is RM1.90, so therefore if we times it with, we multiply it with 100 units, therefore the minimum amount of investment is 190. And last but not least, we have KLCC Staple Securities, where the unit price is RM6.83. So therefore the minimum amount of capital that you need to prepare to invest is 683 ringgit. Yep. So as you can see, the minimum amount of capital that you need to prepare in order to make that kind of investment is vastly different. So as you can see here, for physical properties, if you are looking into physical properties, it is actually very capital intensive. Whereas for REITs, it is actually a lot more affordable. So which means say if today you have about 1,000 ringgit in the bank account, you can consider starting a REIT portfolio already. Because why? Because it is actually very affordable. Okay, so the first factor that we need to consider is what is the amount of investment capital that we have. Okay, if we have actually prepared a huge sum, then maybe we can consider physical properties as an option. Otherwise, if let's say we are starting a small portfolio, a small investment portfolio, then maybe we can start off with a REIT. Now let's move on to the second factor that we need to consider, which is the word leverage. Okay, so leverage is actually very important. So let's take a look at this word leverage. Now, looking at physical properties, okay, so like I said, most investors in Malaysia, we are not cash rich enough to actually, if let's say the price of a property is 300,000, 400,000, or $500,000, or a lot more than that, nobody has that kind of, not many people, especially if they are young today, they have $500,000 in capital to start with. So therefore, most of us will actually take up loan, which is actually a form of leverage. Now, when it comes to that, okay, the first and second residential property that we buy in Malaysia as a local buyer, we can actually get up to 90% financing for that property. So meaning to say, if let's say today we are buying a residential property, which is priced at $500,000 or 500,000 ringgit, we can go to the bank and apply for 90% of that 500,000 ringgit, which is 450,000 ringgit. Okay, so that's for the first two properties in Malaysia. Then of course, once you have actually bought your first two properties, or at least you have two residential loans in Malaysia, the third residential loan that you are getting from for a piece of property in Malaysia, the bank will actually allow you to borrow up to 70% of the property price. So meaning to say, let's say we are considering a piece of property which is priced at $500,000 or 500,000 ringgit. So if you are a first-time buyer, you can get up to 90% loan, which is $450,000 in mortgage. However, if let's say today you have already bought two properties and right now you're considering this as your third property, then the amount of loan that you can actually get is $350,000, which is 70% of the property price. And of course, if you are looking at commercial properties, then the amount of financing could be 80 to 85% of the property price. And the rates will be actually different if you're looking at the industrial land or industrial property or an agriculture land or property. Okay, so you have to check out the banks in order to find out what is the amount of financing. Okay, what's the amount of financing that can be granted for that kind of property? Now, when it comes to this kind of properties, right, the leverage actually depends on us as investors. Okay, why? This is because when we apply for a loan from the bank wants to know whether or not we are credit worthy enough to pay back the loan. So in other words, if we want to buy a piece of property, it is very important to be seen as credit worthy. All right, which means to say, if you want to have that kind of if we want to have that kind of loan, that kind of financing, the leverage, this kind of leverage, right, it depends on our financial strength. All right, so we need to be financially strong in order to get loan from the bank. All right, so how does the bank actually assess our creditworthiness or our financial strength? So the answer is very simple. So the banks will actually take into consideration our CRIS, our CTOS score, and they will actually calculate the debt service ratio based on our current debts that we have and based on our income. Okay, so if the bank deems that if the bank actually sees us as creditworthy, then of course we'll get the loan. Otherwise, if let's say the bank thinks that we are not so creditworthy, then we will not get the financing to purchase the property. So all in all, what I'm trying to say here is this. When it comes to leverage, yes, we can actually use loan to leverage on buying physical properties. However, the leverage, right, it actually depends on us. Because if you are not financially strong, then we cannot use this leverage. But when it comes to a REIT, the leverage is not on the REIT investor. Okay, so let me repeat that again. When it comes to REIT investment, the leverage does not fall on to the REIT investor. Okay, so today, whether or not I'm financially strong, it doesn't matter, all right? It doesn't matter, okay? Which means to say today, you can be not so financially strong, or it doesn't matter, all right? Whether or not you're financially strong or not, you can buy a REIT. It's as simple as that. As long as you have some cash, some form of cash savings, okay, you can start a REIT portfolio. This is because the leverage does not depend on the investor's financial standings. But in order to grow, all right, a REIT must be financially strong. So therefore, the leverage will fall onto the REIT, okay? So if you want to invest in a REIT, like me, for example, let's say, for example, I'm looking at a REIT to invest. What I like about a REIT is that if a REIT is financially strong, it can actually borrow more money to buy more properties, okay? But in order to do that, the REIT, not the investor, must be financially strong. So therefore, all right, when it comes to assessing the financial strength of the REIT, we will actually calculate a ratio, which is known as gearing ratio. So in Malaysia, okay, for Malaysian REITs, the gearing ratio is actually, there's a limit to it. And the limit is actually 50% of the REIT's total asset. So how is it calculated? It's very simple. So what happened is that we take the REIT's total borrowings, we divide it with the total asset of the REIT, we times 100%. As long as this ratio is below 50%, all right, that's actually good enough, all right? For some REITs, sometimes their gearing ratio is about 45%. So if I look at a REIT where the gearing ratio is like 41, 42, 45, 49%, that means to say the REIT does not have much borrowing capacity to buy new properties for growth. However, if I look at the REIT and then the gearing ratio is low, right, like 30%, 20%, this means that the property, okay, this means this kind of REIT where the gearing ratio is about 20, 30%, and the limit is 50%. So this is something that I will look into because the REIT, this shows to me that the REIT has the ability, okay? They have the borrowing capacity to go to the bank to get a loan to buy new properties for investment. Okay, so therefore, if you ask me, which of the two REITs are better? Is it the low gear REIT or high gear REIT? I would say the lower gear one has an advantage to go to the bank to get loans to buy new property. And this kind of leverage does not fall onto the investor because it doesn't depend on my financial strength. Rather, the leverage is actually more dependent on the REIT's financial strength. Okay, so that is actually the beauty about REIT investment. So when it comes to the topic of leverage, for physical properties, the loan, the financing, the leverage depends on the individual investor. Whereas for REIT, the leverage depends on the REIT's financial strength. So here is actually how I look at things. So today, if you are listening to this session, to my sharing session, right? If let's say today your CRIS, your CTOS, your debt servicing ratio is actually on the low side, that means to say you are very strong in your creditworthiness, then maybe you can actually consider, you have the option to actually consider physical properties as an investment, or you can actually choose to invest in a REIT if you want to. However, if let's say today your CRIS is not that good, you don't actually have a good score when it comes to CTOS, your debt service ratio is actually kind of like on the high side, then I will say that maybe physical properties is lesser of an option for you as your next investment. Rather, you can actually look into REITs. You can actually explore into REITs when it comes to building or making small investments. Okay, so it all depends on your financial circumstances. Now let's move on to factor number 3, where I'm going to talk about asset and tenant quality. Now let's start that. Let's look at physical properties. So when it comes to physical properties, let's say we are looking at a residential property. So typically speaking, when it comes to buying a residential property, who are your potential tenants? Okay, so this one is actually very important. Most likely, the tenant group will fall under a few categories. The main one will include university students, working adults, or even families. Okay, so which means say most of the tenants that you're gonna get if you are buying a residential property are people. Okay, are individuals or families who need a roof on top of their head. Okay, so therefore these are your tenant groups. And when it comes to managing your own property, most of the time as a landlord, you will either self-manage the property, or you may, in most recent cases, most people they could actually outsource this kind of property management to some smaller property management firms. Okay, so either you manage your own property, or you just engage a smaller property management firms to manage your own residential properties. And when it comes to the duration of rental, which means say your tenancy contract or your tenancy agreement, or the tenure of your rent, okay, so usually these kind of things, it can be a bit short for residential properties. Okay, for example, some people tend to do Airbnb. So when it comes to Airbnb, these guests, all right, or these people, these occupants who actually occupy your property, they can occupy your property for maybe a few days or perhaps a few weeks. Okay, because they're not going to stay there for the long term, right? Because you're doing Airbnb. Sometimes we may get tenants who actually want to rent our residential properties for the short term. So maybe you actually have attracted maybe a nurse, maybe a doctor who wants to actually rent a place for the short term so that they can complete their internship. Okay, so when it comes to short-term rent, the duration of the rent could be 3 months to 6 months. Okay, so that's short-term rent. And of course, the standard case is that for most university students, working adults, and families, maybe you will sign a tenancy agreement where the duration of the where the duration to occupy the property is about 1 to 2 years. Okay, so it depends on the contract. Okay, and of course for this case, but in typically speaking, when it comes to residential properties, the duration is much shorter. Now, this is actually a different story if you're looking at a REIT. All right, so for most REITs, we are not dealing with individual tenants. We are dealing with, the REITs are dealing with corporate tenants. Okay, let's say for example, we look at the retail mall. Okay, so all you need to do is just go and walk around in the shopping mall. Then you will see all kinds of tenants. Okay, so for example, you can have high quality tenants like Starbucks, KFC, and fashion retailers like Pardini, Uniqlo, Brands Outlets, H&M, and so on and so forth. All right, and so that is actually for shopping mall. But what if actually the REIT has an office building or has a portfolio of office buildings? Then you can have, in the case of KLCC Securities, well, they can actually have Petronas or ExxonMobil as their tenant. All right, and you can have all kinds of corporations to become your tenants. So that is actually for office buildings. And for Axis REITs, where they have warehouses and small factories or logistics properties as their investment properties, well, they can have another group of tenants like Post Logistics, Nestle, and so on and so forth. You know, all the logistics operators who want to actually operate their logistics operation, or they want to operate a warehouse operation over there, then this could be your tenants. And of course, we have KPJ Hospitals, who is a hospital operator, being the tenant of LRK REIT for all the KPJ hospitals that they own. So what I'm saying here is that when it comes to REIT, the type of tenants that we are dealing with are corporate tenants. So when it comes to property management, of course, it's going to be very professional. It's a lot more professional than, you know, like us, you know, self-manage our own property. So for us, we just manage property by ourselves, or mostly, or even if we outsource, we are just outsourcing to a small property firm. However, when it comes to dealing with multi-billion-dollar properties or multi-million ringgit properties, of course, they are going to engage professional property management companies to manage these buildings. And when it comes to the duration of tenancy, so this one actually it depends on the nature of businesses and the nature of the industry themselves. So some of the REITs I see that for retail REITs, for retail properties, usually the duration of these tenants, the duration of these tenancies will be somewhere between 2 to 3 years. But when it comes to hospitals, I'm not saying KPJ, they could stretch for a very, very long time. Like for example, Sunway Hospital, okay? Sunway Medical Center, the tenancy can go up to 10 years. And if you look at Sunway University, that one is actually quite very, very long, all right? So Sunway REIT owns Sunway University, the campus, and the tenancy for that is actually like more than 10 years. It could go all the way up to 20, 30 years, all right? 30 years, in fact, if you actually go and take out the annual report. So you can, as you can see, it depends on the type of properties. But what I'm saying here is that the duration of this lease can be very, very long, all right? So therefore, when it comes to assessing a REIT, we always have to look at how long is the duration of this kind of tenancy agreements. Of course, for us as a REIT investor, the longer, the better, right? So therefore, the thing that we need to consider under factor 3 will be the type of assets and the type of tenants. So for physical properties, we are dealing with individual tenants, and for REITs, we are dealing with corporate tenants. Now, moving on to factor number 4, where we are going to talk about methods to do due diligence. How do we do homework on this how do we do homework on these two types of investments? Now, when it comes to physical properties, here's how we typically would do our homework. Number one, we go for property viewings. Of course, before we actually invest in the property, we go and view the property. Why? This is because that we can touch the property, we can see for ourselves the property, we can use our five senses to actually feel the property. We can actually get to know about the structure of the property. We get to actually look at the surroundings of the property. So therefore, the first thing that we do is that before we even talk about the price of the property, we go for property viewings. And when it comes to determining the final price of the property, of course, as a landlord, as a property investor, we are highly dependent on real estate negotiators or real estate agents. So these are very important people who will help us to negotiate, hopefully, the best price for us, all right, in our favor, hopefully. And when it comes to, but of course, before we actually engage the RENs and the REAs, we will tend to actually research for the property, the type of property that we want to invest in and their prices from all kinds of property websites. The main ones will include iProperty, Property Guru, and so on and so forth. And last but not least, here is the thing that I would do as a property investor. So in order to get a rough gauge of the market or the latest property transaction prices, I tend to go to Bricks and find out the price. Okay, it's actually very easy to do. You just go to Bricks, the website Bricks, and then from there you just type in the property. You can actually type in the location of the property, and from there they will actually make a list of the properties, the neighboring. You can actually find out the latest transaction of that surrounding, that project or that development or that township. What are the latest transacted prices? And then from there, you have a rough estimate. Okay, so this is actually roughly how much the properties are being transacted at that price. So this is actually very important because as a property investor, you don't want to overpay for a single property. So therefore, use Bricks, okay? Bricks will actually help you to get a feel of what is the latest property transaction price at that township or at that area. Use Bricks, very helpful. But then the thing is that when it comes to doing homework, when it comes to investing in a REIT, of course, we are not going, apart from shopping malls, we are not going to go to every single property that the REIT owns to actually touch the property, view the property, and feel the property. That's not very practical. So how do we do homework? Well, the best way to actually do homework is to use the Bursa Malaysia website. From the Bursa Malaysia website, you can actually download both the annual report and the quarterly reports of all these REITs. So these reports, I would say the annual report will tell you what exactly are the properties that they own, the location of all of these properties, the type of these properties, and the quality of these properties in their portfolio. So all this information are readily available at the annual reports of these REITs. And all these annual reports can be downloaded at the Bursa Malaysia website. Okay, so please do visit the website, very important. And once we get to know the property portfolio inside the REIT, the next thing that we will do as an investor is to check out the financial results of the property. The financial results of the REIT itself. Okay. Now, just now I've said financial results of the property. Now that depends. Okay. So here's a trick, guys. Here's a trick that I will use. Okay. Some REITs in Malaysia, like IGB REIT, they only have 2 properties. They only have Mid Valley and the Gardens. Just these 2 properties. So for IGB REIT, you can actually find out the financial result for these 2 properties because only 2 properties. Okay, so you just go and check, do a little bit of homework, and you will find out the financial results of these 2 properties. However, for a REIT that has a lot of properties, then it's not so practical to just look at the financial results of each of the properties that they own. So let's say they own, let me just see, let me just think. Let's say we have, okay, you can use Sunway, okay, let's say Sunway REIT. They have about 17 properties, I believe. Okay, to my knowledge, all right, 17 properties. Yes, you can still look at every single one of the property, the financial results if you're hardworking. However, if let's say you are less hardworking, because Sunway REIT has a very diversified type of properties, they have retail malls, they have hospitals, they have their university campus, they have an industrial property, all right, and as well they have office buildings. So maybe you can actually check out their segment, the segmentized financial results for the classes of property, and from there you can actually get to know about Sunway REIT a little bit better, right? And of course, once you have done that, you can see that all these financial results will be reflected in the group's financial results. So this is actually one way you can actually do the homework when it comes to assessing a REIT for investment. And as for the financial strength, it's very simple. You have to calculate the gearing ratio. So as mentioned just now, the low gear ones is like people who have the income but don't have much loan. They got the chance to go and buy new properties because why? Debt service ratio is low. However, if you have a guy who has this kind of income but their debt repayment is already here, which is like very close to their earnings, then forget it. I mean, this guy better don't buy property, right? He's gonna max out on his income already, so better not. So this is actually a way to gauge a REIT's financial strength. Now, when it comes to REITs, it's very simple. Okay, I will actually take I'm actually very particular about this. When it comes to the financial results of the REIT, I will check its revenue, net property income, distributable income, and DPU. These four things, everything must grow on a consistent basis. Okay, so if a REIT has been listed for the past 10 years, the REIT's revenue, net property income, distributable income, and DPU must grow. And it must grow consistently. Okay, the only exception I would give is for COVID-19. Okay, some REITs, they have very good growth. All right, they have very good financial results. However, they were impacted by COVID-19. So in this case, I will accept. Okay, I will accept that if the REIT has actually recorded a drop in revenue, net property income, and distributable income, and it's because of COVID-19's reason, I say it is justifiable. Okay, why do I say so? Because hey, MCO, I mean to say, it's not because the retail mall is bad or what. It's just that government announced MCO. So who can go shopping? Who can, just, so even the shopping mall, there's so much restriction when it comes to shopping in a retail mall. So when it comes to this, it has nothing to do with the actual ability of the REIT to make money. When it comes to investing in REIT, it's very important for us to assess the true ability, the actual capability of the REIT to make money, not because of circumstances. So if the REIT actually reported a fall in income because of these kind of circumstances, personally, for me, I will accept. All right. This is because, as an investor's point of view, I want to buy based on the REIT's true ability to generate income. So when it comes to homework, how do we do homework when it comes to both types of investments? For physical properties, we can go for property viewing. We can touch, we can see, and we can feel the properties. But whereas for REITs, we are very heavily dependent on financial reports. And these financial reports, annual and quarterly reports, they can be downloaded from the Bursa Malaysia website. And last but not least, we have factor number 5, which is income tax or taxes. So for physical properties, if we collect rental income, we must file in our rental income to the tax authorities. However, the thing is that, let's say we receive certain amount of rental income. However, we can actually deduct from the rental income the following expenses. The first one is if we take a loan for our properties, the interest cost is deductible. If along the way, we actually incur some repair and replacement costs, then we can actually then that is actually tax deductible. So let me just explain what do I mean by replacement costs. Okay, so first and foremost, I'm not a tax agent. I'm not an accountant. All right, so this one is actually it's just from my findings, from my own homework, from a book on income tax. Okay, so here's what it says about replacement. So let's say, for example, I have an aircon, it broke down. If I choose to repair it, that's repair cost. If I choose to replace the aircon because the aircon is old and I replace it with a new one, then that's called replacement cost. However, if let's say in the property unit, I have 2 aircons and I add 1 more aircon, make it 3, that new aircon is not the new aircon is not exactly repair and replacement costs because that is a new aircon. Okay. Now, if we pay for property insurance or takafu on the property, that is deductible. And last but not least, we have land and assessment taxes. If you pay them, that's deductible. So that is actually your cukai pintu and cukai tanah. So that one is deductible. Now, when it comes to filing your income tax, the actual amount of tax that you pay on your rental income is very dependent on your annual income. So which means to say so it really depends on your business income, whether or not you have any business income, your employment income, your rental income, your dividend income, etc., etc., etc. You will have to tabulate all these things, and then from there we will see what is your tax rate. Then from there, we can actually calculate the final amount of tax that you are paying to LHDN on your rental income. Okay, so that is just rental income. But what if you are actually selling off a property for a gain? Well, therefore, we have to pay RPGT. Okay, so now RPGT, it depends. Okay, it is very important for investors to actually get the latest news on RPGT. But of course, suffice to say over here, if you buy a piece of property and you hold it for less than 5 years, of course you are going to pay RPGT lah. All right. Anything above 5 years, then it depends on the latest government. We have to actually check out the latest government announcements for it lah. All right. So we have to be very aware of the tax rates. Okay. But of course, for Malaysian property investors, I believe there is such a thing called once in a lifetime waiver. So which means to say, although you make substantial gain from your property sales, best to evaluate whether or not you should use the once in a lifetime waiver. Use it. So therefore, use it wisely. Yeah. Okay. So when it comes to physical properties, we are going to pay rental income to LHDN. And if you sell a property for a substantial gain, RPGT will apply. Now, when it comes to REIT, when it comes to REIT, we will get distribution per unit. Okay. Now, which is known as DPU. Okay. Which is like a dividend like that. All right. So let's say we got DPU. Now, this DPU, okay, it will be broken down into 2 parts. The first one would be taxable DPU. And the second one would be non-taxable DPU. Of course, the non-taxable DPU, you don't need to pay taxes on it. Simple, because it's non-taxable. But on the taxable DPU, let's say you are a retail investor in Malaysia, individual investor in Malaysia, we have to pay withholding tax on this taxable DPU. And the rate is a flat rate of 10%. So now the thing is this, it doesn't matter your income is 50,000 ringgit a year, 100,000 ringgit a year, or 1 million ringgit a year. It doesn't matter how rich or how poor you are. Everybody, all the unit holders will pay the same amount of tax, same amount of withholding tax. I mean to say same amount of tax rate lah, all right? And that tax rate is flat 10% for everybody, rich or poor. As long as you are a unit holder, 10%, okay? And the best part about this, and the thing about this withholding tax is, the REIT will make this payment on behalf of us to LHDN. So what happened is that, although it's declared, there's a DPU declared, but at the end of the day, we will receive the net DPU after paying off the withholding tax. Okay, so as mentioned on the screen, the tax rate here is a flat rate of 10%, and it is not based on individuals' annual income. Now, here's another thing. Let's say, for example, a REIT purchase a property, a commercial property, let's say at the price of 500 million ringgit, 500 million ringgit. And slowly over time, after 5 years later, it received an offer where another company want to buy over the property for 1 billion ringgit, double the price of his investment, initial investment. So the thing is that, do we need to pay RPGT on this property? The answer is no. Okay, so this RPGT thing, leave it to the REIT. As investors, we don't need to be concerned about filing in this RPGT to the LHDN. It is on the REIT will actually take care of it. Let the REIT administer all these things. Okay, so when it comes to REIT investment, there's lesser hassle when it comes to taxes, especially when it comes to administrating your tax or filing in your tax issues. All right, less issues on that. So therefore, when it comes to tax issues for physical properties, you need to file in your rental income to LHDN. As for REIT, the REIT will help you to pay the 10% withholding tax on its DPU, the taxable portion of the DPU. Okay, so we have actually gone through the 5 factors. All right, now I'm going to just do a little bit bonus sharing lah. So this bonus sharing will involve this next question, which I will answer it very shortly, which is, what factors are required to succeed in both REIT and physical property investments? Okay, so what are the key factors if you want to be successful in REIT investment? What are the factors that we need to have? What are the ingredients that we need to have in order to succeed? And likewise, if you are looking into physical properties, what are the factors that we need to have in order to be successful in this area of investment? So let's find out. So personally for me, right, actually it's not really a contest between REITs versus physical properties. Okay, it's not so much about which is actually better. Rather, I would say that the first thing that we need to consider is not the investments. Rather, the first thing that we need to consider is the investor, which is ourselves. So therefore, in light of that, I would like to say that these are the 3 ingredients that I think which is very pertinent when it comes to to actually assess whether or not we can be successful in REIT or physical property investments. So these 3 will include the mindset, the belief system that we adopt as an investor, our objectives, and finally the system, how we actually invest. What is actually our modus operandi when it comes to making these investments? So what are the processes? Okay, what are the steps taken in order to make this investment work? So this is actually the 3 things that we actually need to actually consider first in order to be successful in any investment, be it property or stocks. Mindset, objective, and system. Okay, so let me just illustrate. Now, let's say, for example, today, if you ask me how to be a good stock investor. So based on these three ingredients, we have mindset, objectives, and system. Okay. So for myself as a stock investor, when it comes to mindset, right? All right. Let's say our mindset is to be a good stock investor. And in order to be a good stock investor, we tend to learn investment methods from the great, okay, from who we believe as a great investor. So of course, this will include people like Warren Buffett. So therefore, our mindset will be like, okay, we are going to do fundamental investing. We are going to try to adopt or try to learn from the writings or the essays of Warren Buffett. And from him, it is very likely that what we will do is that we will buy good assets and we will tend to hold it for the long term. Okay, so which means to say the mindset is when it comes to stock investing, we come into the stock market to buy stocks, shares of good companies, and we tend to hold on to them for the long term. We are not thinking of how do we actually sell it for a quick profit. That's not our game. So that's mindset. Now, when it comes to objectives, so different people will have different objectives. Like for example, for myself, let's say I'm a dividend investor. My objective could be to invest to get dividend income. And let's say, for example, here, I have a simple goal where I aim to achieve 4% per annum in dividend yields from each and every single stock that I buy. So that's my objective, okay? So the mindset is fundamental investing, buy good stocks, hold for the long term. My objective is to earn dividend income, and I would like to achieve 4%, at least 4% per annum in dividend yields from all the stocks that I purchase. And then last but not least, I have my system. So system means to say what are the processes to allow me to fulfill this objective. So for example, for me, I will actually download annual reports, quarterly reports. I will study the company's finances, and from there, if I believe that if I find that the company has a track record of they have a good track record when it comes to their financial performance, they have a good business model, they have a strong management team, they have a good track record, they have some growth initiatives in place. And after that, I value the stock and it actually can give me the 4% per annum in dividend yields, then I would say that's good enough. So that is actually process. Okay, that is actually process, and that is actually my system when it comes to investing in the stock market. So we have mindset, objectives, and then we have system. And this kind of system, right, it's actually quite translatable into property investing. Okay, so let's say, for example, it's the same. Stocks, properties, same. So let's say, for example, mindset. So now the mindset is, okay, I'm going to look at a property to invest. So the key thing here is that if let's say I want to do fundamental investing like Warren Buffett, but now in the property market, so just like buying good stocks to hold forever, I will buy good properties and I will hold them forever, or I will hold them for the long term. So that's the mindset. Now, when it comes to objectives, instead of like stocks, my objective is to earn dividend income. So for properties, it's the same. I would like to get rental income from my properties. And let's say, for example, I would like to achieve 4% per annum in rental yields. Okay. So stocks, I would like to get dividend income, 4% dividend yield. For properties, rental income, 4% rental income per annum. So what's the system? So therefore, I will actually build a system whereby I will actually put in the criteria that I would like my properties to have, and I will actually use that criteria, the checklist, to actually assess the properties. And from there, I will use rental yield to evaluate the property, to calculate my offer price so that I will not overpay for my property. So that is actually the process. So that is actually an investment system. So as you can see, when you have mindset, objectives, and system, it doesn't matter what investment that you get into, be it stocks or properties, the principles are the same. It's just that the product is different. All right. However, it can be a very different thing if you're listening today, you are a stock trader. So let's say, for example, if you're a stock trader or you're a speculator. So let's say what you have in mind is that you want quick profits and you just want to hold onto a stock for the short term. Okay, you want to make fast money. That's your mindset. So when it comes to the objective, it's very simple. You just want to attain fast and big capital gains. The faster you can get the capital gains, the bigger capital gains that you can get, the better. So that is actually your objective. So what is the system? Well, so it depends. If you are a stock trader, maybe you use charts and technical analysis tools to help you to make better trades. Or if you're a speculator, then you try to chase anything that goes up for quick capital gains. Okay, so you're actually using greed. So let me say you have some form of greed. You have some form of emotion. You have some form of you got to participate in this kind of spikes in order to you want to actually join in the bandwagon when it comes to this kind of stuff, and therefore that will be your guiding factor to why you buy into a stock. Okay, so that is actually your mindset, your objective, and your system. And you can find these same people in the real estate market. Okay, so let's say it's the same people who want quick profits and they just want to hold onto a property for the short term, and they want to attain fast and big capital gains. So of course, they will actually look for properties that they think that they can actually flip it for faster gains. So basically what I'm saying here is that it's not which of the two investments are better. Is it stocks or properties? So my point is that it all depends on your mindset, your objectives, and system. Okay, if your mindset is to make fast gains, you will find anything that will help you to get fast gains. If let's say, for example, if you're operating like Warren Buffett, you want to be very fundamental when it comes to your investment. You want to have a proper system when it comes to evaluating you want to have a process to actually assess your investment, and then you want to have a calculation. You want to have a formula to actually evaluate the value of the investment before making your investments. Then of course you will try to replicate that in any kind of investments, be it stocks or properties. So now the question is this. All right, now I'm coming to the end of my presentation. The final question is this: which of the two investments will be more suitable for you? Is it REITs or is it physical properties? Let's take a look. So I would say that it all depends on your situation. So just now, factor number one, we look at capital. So today, if let's say, for example, you have huge capital, you want to start you want to actually buy a physical property, you need huge capital. Like, of course, just now I used the example of 300,000, and you need an initial capital outlay of 75 to 80,000 ringgit. Of course, if you are looking at $500,000, then you need a lot more. You need more than 100,000 ringgit in order to start this kind of portfolio. However, if you just want to invest in a REIT, then you don't need so much money. Okay, even a few $1,000s, you can actually start a REIT portfolio. Now, when it comes to your financial commitments, okay, so let's say, for example, if you are one of those people who have very low debt servicing ratio, good secrets, good CTOS, then of course you can choose any of the two. But if you have a lot of commitments already, you have a lot of commitments, you cannot, you don't have the capacity to go to the bank to obtain more loans, and you have a not so good secrets and CTOS score, then I would say maybe REITs will be more suitable for you. And then next, when it comes to management, property management, if you choose to self-manage your property, then of course, physical properties will be your thing. If you like it better that the properties are being professionally managed, then you may want to consider starting a REIT portfolio. Now, when it comes to transactions, right, it depends on your preference. Let's say, for example, if you are the type who likes to negotiate, all right, you like to tawa menawa, you like to offer a price and then counter offer. Then of course, physical properties will be your thing. However, if you are the type who say, actually I'm quite malas, I don't really want to negotiate here and there. I just want to make the investment with just a few clicks of the button. Then of course, REITs will be much better lah, because you can actually buy a REIT with just a few clicks of a button. And last but not least, when it comes to deciding between the two, it depends on your investment planning. So for me, what I did was, I typically, what I can say is that sometimes, right, you can actually buy a REIT first, because physical properties, right, it's not like today I want to buy property, I want to buy a physical property, tomorrow I can buy already. It doesn't work that way. Sometimes these physical properties you need to go and find. You need to go for countless of property viewings, right, in order to get the right property. So this whole process will take you weeks, months, or even 1 or 2 years before you actually landed yourself a good property. Okay, so the whole process may not be immediate. So for myself, the first property, right, it took me more than a year just to buy the property. It took me more than a year just to view the property, talk to agents, and go for a tour, merry-go-round before you buy your first property lah. All right, so it takes time to buy physical properties, and during this period of time, of course, you can, I can actually buy more REITs. All right, I can buy more REITs as I go for my physical property shopping lah. All right, so this is actually something that you can consider. All right, you can mix and match the two to actually suit your own investment objectives. All right, so with that, I have covered my sharing session today, but I believe that I'm just starting because what I would like to do is that I would like to answer each and every single one of your questions. So with that, I would like to pass the control back to Shane. Shane, back to you.
All right, thank you, Ian. So for the very comprehensive comparison between the physical properties and also real estate investment trusts, I guess many of you here will be more familiar with the differences between the two. So if you have any questions, write them in the Q&A box, not the chat box, yeah, so we can better manage your questions. All right, so the first question is by Paniram. Where can we get the REITs? Is there any platform available for us to compare the REITs funds prior to purchase it?
REITs funds means what? Unit trust?
REITs, I think it should be REITs. I believe it should be REITs to compare the REITs prior to purchase it.
Okay lah. Of course, you put that. I'm also looking at the question. If you put REIT fund, unit trust that invest in REITs, no need lah.
So far, we have an ETF that invests in REITs. So that's issued by Afin Huang, if I'm not mistaken. So that ETF owns a number of REITs across Asia, ex-Japan, if I'm not mistaken. You can check out by this issuer if you're referring to a fund that owns REIT. Okay, but REIT itself already owns a portfolio of properties. If you invest in an ETF that buys REITs, then you own, even more diversified portfolio of properties.
In the context of Bursa Malaysia, where can we get the REITs? Bursa Malaysia lah. I mean to say you have a list of 18 REITs. The platform to buy, just go to your stockbroker lah. So for me, I use Maybank IB. You can use any other brokers that you feel comfortable with, be it public bank, stockbroker, CIMB Bank, whatever bank, or Afin Huang, or Rakuten. Yeah, all these are platforms that you can actually get the REITs. But if you want to say platform to compare the REITs, okay, because Malaysia, we only got 18 REITs. Actually, it's very easy to compare them one. Okay, let's start with Bumiputra. Let's say, for example, if you're really into the Sharia compliant thing, you only got 4. So all you need to do is just study the 4 and choose any one of the REIT if you feel that these 4 meet your investment criteria. Otherwise, don't invest in the 4 REITs. Then go and buy some other stocks that are Sharia compliant. But if you're not so particular about Sharia compliance, then do you actually every single day or every single take 3 days to you can even take 3 days to study one REIT. By 1 or 2 months time, you have a full complete understanding. You have a very good overview of all these REITs already. Then you can actually make a decision from there lah. You don't need a platform to compare these REITs. That's the
Alright.
best I feel. Yeah.
Thank you so much, Ian, for answering the question.
Mhm.
The next question is, how do we evaluate a REIT? Is it possible for the REIT to go bankrupt together with the company that it is offered from tied to?
So far, out of the 18 REITs, no REITs go bankrupt lah. All right. It's very hard for the REITs to go bankrupt because in Malaysia, there's a limitation when it comes to gearing ratio. So the gearing, right, at least it has to be, the maximum is 50% only lah. So which means if the property price is $1 million, the maximum amount of total borrowings is about half a million only. Half a million only, which is like $1 million in property value. The maximum loan is $500,000. That's the max. So most of the REITs, their ratio is actually somewhere between 30 to 40% lah. All right. So it's a bit harder to go bankrupt. I think most people who go bankrupt first, the ones that go bankrupt first is the ones who overgeared on physical properties. These are the ones who are more prone than REITs. So I don't think bankruptcy at this moment is something to be considered lah. But the quality, the fundamental quality of these REITs is something that we need to compare. That one, yes.
Like when we buy property, the 3 criteria are location, and location, correct? So when we compare REIT, it is also important for us to assess the fundamental quality. Right? But just now when you talk about the debt versus asset ratio, right, cannot be more than cannot be more than 50% that is set by Securities Commission. That is applicable to the whole REIT itself, right? Not by project, right? Not by property, right?
No, it's
the whole company, the whole REIT. Okay. So if there are some projects that they cash buy, then other projects they could take 100% financing. So long that the REIT itself don't have more than 50% of their asset financed by debt, that should be okay, right?
Yeah.
All right. The next question is, how will work from home trend affect office REIT? That is from Ben.
Okay, so I believe if you ask this question, you have a preconceived idea of how this work from home thing, right, can affect office REITs already lah. All right. So let's say you are skeptical about these office REITs, then the best thing is to not touch them. All right. So that is that. If you just want to avoid this kind of stuff, then you can go with other classes of other types of REIT lah that doesn't have an office building as their property portfolio lah. To actually see this trend, I couldn't actually give you a much comment on this, but for me, it's not so much about the work from home thing lah. For me, it's more like what's the office supply lah. So in KL, if let's say the office supply, we are now oversupplied, then of course that will not be a very good thing lah. Not a very good thing when it comes to office rentals for office buildings lah. Yeah. So back to work from home, right? I think that it really depends. I believe that there are still some market for offices, especially there are some demands for corporations. They still believe that having an office, right, is more professional looking, and people like to go and work in the office because some people, they may not. I mean to say it depends. Work from home can be a joy for some people, but it can be a nightmare for some people also. All right. So let's say, for example, if you're single, nobody is disturbing you, then work from home is like heaven. But if let's say you have kids running around and then they are screaming and then they require some of your attention, then work from home is not so conducive. So there's still gonna be some demand for office spaces where people can really go to an office to sit down and concentrate on their work. So I mean to say, work from home will not. I don't think it will kill entirely the office spaces, because I still see that for some people, right, working from office still works. But just but if you don't want the risk, just eliminate the REITs that have office buildings.
Okay. The next question is by Melissa. Would you be able to share, whether do we still need to declare the REITs dividends when it comes to income tax filing?
The answer is no, but I'm not a tax agent. Please double confirm on this. But I believe it's no, because you already paid the withholding tax, and it is the REIT on the REIT side that will help you to pay. So once you already paid the tax, LHDN got the money already. No need. And I believe we can find this under a public ruling somewhere. But yeah, actually, I really hope. I mean, but this is a side topic. But no, I mean to say, I'm just commenting that maybe LHDN should come out with HTTPS or something like that, make it more. Then of course, then I will be more. I hope they will do that someday, but that's off the topic. But anyway, I mean to say the answer is no. I don't think so. Yeah.
Okay. The next question is, we know that the OPR has been increased by 25 basis points. So will this affect property or even the REIT stock prices?
25 basis point. Actually, you see, when it comes to buying stocks, or even buying a REIT in general, this kind of things do happen when the interest rate goes up, interest rate comes down, ringgit goes up, ringgit comes down, oil price go up, oil price come down. Leadership in governments, not just in Malaysia, the whole world happens. You cannot be buying a stock based on, I mean to say, I'm speaking on behalf of investors who are like me, who just want to accumulate as many stocks as possible. We cannot be buying or selling a single stock based on a change of a single event, Very stressful. What I would say is that it is better to buy the stock that can be profitable, that can continue to generate increasing amount of profits year after year, despite all these things that happen. So therefore, as long as the fundamentals of the stock is good, the rest of the thing no need to worry so much.
Okay, understand. Yeah. So the next question is by Yap Xiong Wei. What kind of dividend yield is expectable or is acceptable for the REITs investment?
It can be 4, 5, 6, depending on the price. But usually it's around that range.
What is the average yield right now?
Average yield, that one I'm not too sure. Didn't really calculate, but the general acceptable one will be 4, 5, 6, somewhere there. Okay. But then with that said, right, don't just buy a REIT because of the yield, all right? Because some yield can go up to 7-8%, and then you think that's better, that's the best REIT investment. That's not the best. That's not exactly how I will actually assess the REIT. The REIT must be first and foremost the quality, the fundamental quality must be there. Then only we consider the REIT. Then only we consider the yield. It's not the yield over the fundamentals. It's the fundamentals first, then only the yield. So, which means to say, if I give you an example, A versus B, REIT A, REIT B. REIT A fundamentally good, REIT B fundamentally bad. REIT A give you a yield of 4%, REIT B give you a yield of 8%. I'll still go with REIT A, despite 4%. Why? Because the fundamental is better. As for the 8% one, because the fundamental is bad, I can forget it. Yeah.
Okay. So what would be your target average annual percentage return, including capital gain?
That one I never really. Of course, for me, the dividend yield must be above the past average. All right, that will be very important. The past average. Past average simply means if the REIT has a history of a listing history of 10 years. So I will calculate for each year the dividend yield based on their closing price. And then from there, I will calculate the average from there. And then I will compare it with the current. So as long as the current is much better than the average, I may consider an investment into the REIT if the fundamental is good. All right. As to the capital gain, because I'm not the one I'm not the one calling the shots when it comes to ups and downs in the unit prices, because when it comes to stock prices, it can go anywhere, up, down, sideways. So I believe what is more practical at this stage, right, is that if this fundamentally solid and if it's good, it's of good value, I will just accumulate. And so maybe my mindset is more like at the end of the day, let's say you like a certain REIT, let's say REIT A. So at the end of the day, after 5 years or 10 years of investing, how many of this REIT A, how many units of REIT A do you own? That is actually something more insightful lah. Okay, something that I will consider than, oh, I get 50% return from certain REIT, but the amount of investment that you make is 1,000 ringgit. So it doesn't, it's not very substantial lah, you know. So which means to say at the end of 5 years, I do not see the total returns as a thing. Rather, I will see the quantum of dividends at the end of 5 years that I can receive as something to be considered than percentage of returns, if you understand what I mean.
Okay, understand. So Adeline would like to ask, pertaining your 3 criteria on consistent growth, what are the differences between revenue and net property income?
So revenue is like, okay, imagine like revenue is like your rental income. Then you have to minus off some expenses lah, all right? Some property management expenses. Then therefore you get your net property income. So in the world of stocks, right, we have sales minus cost of goods sold in order to get gross profit. All right. So it's like, for example, let's say, this is my phone over here. So let's say it costs about $200 to manufacture this phone. That's your cost of goods sold. I sell it at a retail price of, let's say, 1,000 ringgit. So 1,000 ringgit minus $200, and your gross profit is 800. So in the context of REIT, 1,000 is your rental minus off your expenses, and therefore you get your net property income.
Okay, thank you, Ian. The next question is, how do we evaluate the quality of the management?
Check out his financial reports. That's the best way lah. That's the best way. But apart from the financial report, right, we can, usually there are some metrics on. Okay, I'm gonna just share with you a couple of key metrics lah. And if these metrics are there, usually they are pretty good. Number one, check out the occupancy rate. So if all the properties that they own, the occupancy rate is above 95%, right? Very good already. But if let's say you have some REITs where most of the property, their occupancy rate is 80%, 70%, 50%, don't need lah. don't need to consider that kind of REIT lah, because in Malaysia there are REITs that achieve more than 90+% occupancy rate. So that's actually the first one. The second one, of course, is the financial results. That's very important. And more importantly, when it comes to financial results, if you check out the balance sheet, right, there is such a thing called the net asset value, which is like you take the total assets minus the total liabilities, then we have the net asset value. As long as the net asset value per unit is growing, I think it's a good sign. If let's say the net asset value is not growing, it's declining on a consistent basis year after year, not so good lah, this sign, okay? Not very good, all right? Because if the net asset value is dropping, this also could mean that the property valuation is also dropping lah, which is actually not too good lah. Okay, so imagine this. Let's say you have a property which is worth $1 million, and then we have the maximum gearing of 50%. So your mortgage is $500,000. So the thing is that what you want is to have a REIT to have where the property is appreciating. Let's say it go from 1 million to 1.2 million, and your loan is still 500,000. Then you're like, hey, I can borrow, I can borrow another 100,000, to do some renovation works or buy a smaller property or something like that lah. But imagine this property keep on growing all the way up to 2 million, and your loan, let's say, is still 500,000 lah. The thing is that because of the gearing limit of 50%, you got a borrowing capacity of another 500,000, because half of 2 million is 1 million, right? And if your loan is still 500,000, that means you got an additional loan capacity of 500,000 to borrow and buy another property. So in essence, what I'm trying to say here is that you want your properties in the REIT to appreciate in value over time.
Okay, understand. Is there any minimum amount to invest in REIT?
Then just now, like I was salam, the unit price is 48 cents per unit, times 100 unit is 48 ringgit lah. But if you consider to buy a unit, if you are considering to buy a REIT, right, don't buy 100 units lah. It's not going to be very cost efficient. Buy at least 1,000 units or a lot more than that lah. All right, depending on your affordability, because you are going to incur some brokerage and stamp duty fees. Yeah, so buy more, buy in bulk.
Yeah, so the minimum lot is one lot lah. So yeah. So I think some of you here were asking which REITs are better. Unfortunately, in this session, we cannot recommend any REITs. So we are not a licensed investment advisor. So we can't give any recommendation or investment advice. All right. So we were not going to pick those questions. So the next is, can you comment a little bit about Singapore REITs?
Okay lah. So for Besar Malaysia, right, the thing is that it all depends on your affordability, number one. Okay. Of course, if you are a REIT investor, you will love Singapore better lah. But because you got a lot more options, and for Singapore REITs, right, their REIT portfolio consists of not just Singapore properties. Right now, they are expanding overseas as well. So therefore, if you want to have a much more globalized portfolio, then I would say Singapore REITs have something to offer. But the thing is that with that said, right, it also affordability also comes into play. So meaning to say, if you want to buy into a Singapore REIT, the best thing is to have some form of capital lah. All right, some capital like at least 5 to 10,000 ringgit to actually buy one REIT. And of course, if you can keep on saving if you can keep on saving 5,000 to 10,000 ringgit, then of course you can actually consider Singapore REIT as Singapore as a gateway, as a platform to actually shop around for REITs lah. So I think that one is a good thing. That one I think is a good thing. Personally, I also do that. But the thing is that if let's say today, if you're listening and then you're starting a smaller portfolio, maybe you couldn't save 10K every single month or something like that, or you don't have that kind of, or you're not starting from that kind of capital, then of course the better, let's say for example you can save 500 1,000 ringgit a month, then Malaysia will still be a better playground lah, to actually build up your REIT capital lah. Of course I didn't straight away jump into Singapore lah. Okay, because why at that time I only could afford the Malaysian REIT. But of course, so I would say that Besar Malaysia is a good starting playground to actually try out your REIT portfolio, try building a REIT portfolio. Of course, over time you'll get more experience. You're bored with the 18 REITs, then go to Singapore.
Okay, thank you so much, Ian, for addressing that. So I think now, I think in Malaysia we also have REITs that have overseas exposure. I think if I can remember, YTL REITs, right?
YTL has 3 hotels in Australia lah. The Marriott hotels in Australia,
and also Japan, right?
And 2 hotels in Japan.
Yeah.
YTL